Most retail investors are looking at Bitcoin right now and seeing one thing: pain. Bitcoin is down 47% from its all-time high of $126,000. The fear index is flashing extreme fear, and the mainstream financial media is telling you the bull run is over. But here's what they're not telling you. This morning, April 8th, 2026, Morgan Stanley quietly launched a Bitcoin ETF. Not a futures product, not a structured note, a direct spot Bitcoin ETF with the lowest fee in the history of the Bitcoin ETF market. And when Morgan Stanley moves quietly, precisely, in the middle of a fear cycle, that is not a coincidence. That is a signal. Stay with me, because by the end of this video, you're going to understand exactly why what happened this morning is one of the most important institutional moves in Bitcoin's history, and why most retail investors are going to miss it completely. Let me set the scene. Bitcoin is trading at $71,906. It is up $3,636 in the last 24 hours. But it is still sitting 47% below its all-time high of $126,000. The retail crowd is scared. Social media is full of people asking whether Bitcoin will ever recover. Mainstream outlets are running headlines about the crypto winter returning. This is the trap. And I want you to understand something about extreme fear cycles in institutional asset management. When retail investors panic and sell, they create a price suppression window. A window where sophisticated institutional players, the ones managing billions, not thousands, can accumulate assets at a discount before the next cycle begins. We saw this exact pattern before the first Bitcoin ETF approvals in January 2024. Retail was terrified. Institutions were loading. Right now, in April 2026, the same playbook is running. But this time, the scale is different. The infrastructure is different. And the stakes are dramatically higher, because the Bitcoin ETF market now manages $150 billion in assets. That is not a retail product anymore. That is institutional infrastructure. And this morning, Morgan Stanley walked into that market with the most aggressive pricing move we have ever seen. Let me break down exactly what Morgan Stanley did this morning. They launched a product called MSBT, a spot Bitcoin ETF, directly tracking the price of Bitcoin. Not futures, not derivatives, the real thing. But the fee is what you need to understand. Morgan Stanley priced MSBT at 14 basis points. That is 0.14% annually. For context, BlackRock's IBIT, the dominant Bitcoin ETF, the one managing $55 billion in assets, charges 25 basis points. Morgan Stanley just undercut BlackRock by 11 basis points. Grayscale's Bitcoin Mini Trust, which was previously the cheapest fund in the category, charges 15 basis points. Morgan Stanley undercut them by a full basis point. Now think about what it takes for a firm like Morgan Stanley to make this move. Morgan Stanley manages over $3 trillion in client assets. They serve the wealthiest individuals in America. They have financial advisors whose entire business is built on trust and precision. They don't launch products to break even. They don't price aggressively out of charity. When Morgan Stanley prices at 14 basis points, the lowest fee in Bitcoin ETF history, they're making a calculated institutional decision. They are saying, we want maximum flow capture. We want to be the dominant vehicle for high net worth Bitcoin exposure before the next major cycle. That is not bearish sentiment. That is predatory institutional positioning. Now here's where most analysts stop. They report the fee, they notice the lowest in the market, and they move on. I want you to think about this differently. Fee wars in ETF markets are a leading indicator of institutional conviction. This is not my opinion. This is documented market history. When the gold ETF market matured in the early 2000s, the fee compression phase preceded the most explosive period of institutional gold accumulation. Firms raced to the bottom on fees because they were competing for what they believed was going to be a massive inflow cycle. The fee war was the signal that smart money was positioning for scale. Bitcoin is now entering that exact same phase. We have over 10 spot Bitcoin ETFs in the market right now. BlackRock, Fidelity, Grayscale, Invesco, and now Morgan Stanley. Every single one of these firms is competing for the same institutional and high net worth dollar. And when you see that competition reach the fee floor, 14 basis points, that tells you one thing. These firms believe the inflow cycle is just beginning. Here are the numbers. Bitcoin ETFs took in $471 million in a single day just 2 days ago, April 6th. That was the strongest single day intake in over a month. Total cumulative inflows across all spot Bitcoin ETFs have now exceeded $53 billion. That is more than triple the maximum inflows that analysts predicted before ETF launch day in January 2024. The institutions are not leaving, they are accelerating. And Morgan Stanley just made their most aggressive positioning move yet. If this analysis is giving you a different perspective than what you're seeing in the mainstream media right now, I want you to do something for me. Hit that subscribe button. Because what I cover on this channel is the institutional layer of the crypto market. The capital flow decisions, the regulatory moves, the infrastructure plays that retail investors never see coming until after the move has already been made. Don't be the last one to know. Subscribe now and stay ahead of the smart money. Now I want to talk about what I believe is the most underreported story in crypto right now. And it is not Morgan Stanley. It is Charles Schwab. Charles Schwab is the largest retail brokerage in the United States. 38.9 million active brokerage clients. Trillions in total client assets. And 2 days ago, April 6th, Schwab confirmed that it is rolling out direct Bitcoin and Ethereum spot trading to its entire brokerage client base. A Q2 pilot is already underway for select clients. Full launch is targeted for June 2026. Let me put this in the simplest terms possible. Right now, if a retail investor wants Bitcoin exposure, they have options. They can buy through a crypto exchange, they can buy through an ETF, but the majority of Schwab's 38.9 million clients, people managing their retirement accounts, their IRAs, their brokerage portfolios through Schwab, have never touched any of those products. They use Schwab, full stop. When Schwab launches direct Bitcoin trading in June 2026, the barrier disappears completely. You don't need a new account, you don't need a crypto wallet, you don't need to understand private keys or custody. You just log into the same brokerage account you've used for 20 years and buy Bitcoin. Now think about what that does to demand flows. Morgan Stanley is capturing the high net worth end of the market with the lowest fee ETF in history. Schwab is opening the door to 38.9 million retail investors who have never had frictionless Bitcoin access in their lives. And these two events are happening simultaneously. In April and June of 2026, while Bitcoin sits 47% below its all-time high. This is the convergence. This is the institutional setup. And most retail investors are completely missing it because they are staring at the price chart and seeing fear instead of signal. Let me bring this together using the 3 institutional filters, the framework we use on this channel to evaluate whether an asset is in a genuine accumulation phase or just a dead cat cycle. Bitcoin is passing all 3 right now. Filter 1, ETF pipeline. Morgan Stanley just launched the cheapest Bitcoin ETF in history. We have over 10 competing spot ETFs. Total AUM is $150 billion. The pipeline is not contracting, it is actively expanding. Filter 2, settlement utility. Schwab is launching direct Bitcoin spot trading to 38.9 million clients. When the largest retail brokerage in America starts treating Bitcoin like a standard asset class, sitting right next to stocks and bonds in your brokerage account, settlement utility has been confirmed at the highest level. Filter 3, liquidity depth. Bitcoin ETFs absorbed $471 million in a single day just 48 hours ago. This market has the liquidity depth to absorb institutional scale inflows without breaking. This is not a thin, speculative market anymore. All three filters are green. Bitcoin is down 47% from its all-time high. Retail is in extreme fear. And simultaneously, this week, today, the largest financial institutions in the world are deploying the most aggressive Bitcoin infrastructure build-out in history. Morgan Stanley, BlackRock, Fidelity, Charles Schwab. These are not crypto-native firms making a speculative bet. These are the pillars of American finance making a structural decision about the next decade. The coiled spring is tighter than it has ever been. Here is what I want you to walk away with today. Morgan Stanley did not launch MSBT on April 8th, 2026 by accident. They did not price it at the lowest fee in Bitcoin ETF history out of competitive generosity. They priced it there because they believe they are entering the market at a discount, ahead of an inflow cycle that most retail investors are not going to be positioned for. The fear is the signal. The institutional moves are the evidence. While retail is selling, Morgan Stanley is building the cheapest on-ramp to Bitcoin that institutional money has ever had. While retail is questioning the recovery, Schwab is preparing to hand 38.9 million customers a direct Bitcoin buy button in June. The smart money does not wait for confirmation. It moves during the fear. Because by the time retail gets confident again, the accumulation phase is already over. The question is not whether this cycle is coming. The question is whether you are going to be positioned before Schwab goes live in June, or whether you are going to be watching from the sidelines when it does. That is the choice in front of every investor watching this video right now. I'll see you in the next one.